Hello, everyone. Thank you for joining our webinar. This is Alan, Senior Audit Manager. Today, we are going to share with you all about basic accounting and taxation in Hong Kong. During our webinar, for any questions, you may drop your message on the chat box at the right-hand side. We will answer the question in Q&A session at the end of today's webinar or share the relevant information afterward. And you can also click the live chat red button on the top to make an appointment with us for further discussion or consultation. Now we will start our first part of today's webinar, Accounting in Hong Kong. Under Hong Kong companies audience, their directors must prepare financial statements for each financial year that comply with companies audience. These financial statements must comply with the applicable accounting standard issued or specified by Hong Kong Institute of Certified Public Accountants. Moreover, they must be audited by an external independent auditor. On the other hand, the requirements do not apply to the companies that is dormant. Regarding to the accounting, there's no requirement to appoint an external professional accountant to prepare the financial statements. These financial statements can be prepared internally if you or your accounting staff can do so. For the newly incorporated company, the first accounting period is specified by the directors that fall within 18 months after the company's incorporation date. In other words, the first accounts cannot be longer than 18 months. Then, every subsequent accounting period is a period of 12 months after the end of the previous accounting period, unless this is altered. The accounting period can be altered by the resolution of directors, but the altered accounting period cannot be longer than 18 months. About the audit of financial statements, it should be carried out by a practicing certified public accountant in Hong Kong. It is the auditor's responsibility to obtain sufficient documentation in order to issue the audit opinions according to the audit findings. The auditor reviews the financial statements and general ledger of business transactions together with the supporting documents. The audit of financial statements must include statement of financial position, commonly known as balance sheet, auditor's report, statement of comprehensive income, commonly known as profit and loss accounts, and notes to the financial statements. The audited financial statement should be approved by Board of Directors and adopted by the members of the company. There are some record-keeping requirements under tax laws in Hong Kong. Section 51C of the Inland Revenue Ordinance requires Hong Kong taxpayers to keep sufficient records in the English or Chinese language of income expenditure to enable the assessable profits to be readily ascertained. Records include but not limited to books of accounts recording receipts and payments or income and expenditure, vouchers, bank statements, invoice, receipts, records of the assets and liabilities, and records of all entries from day to day of all sums of money received and expended. Such records shall be retained for a period of not less than 7 years. Failure to comply with the above requirements without reasonable excuse may be liable to a maximum fine of 100,000 Hong Kong dollars. Let's talk about electronic record. Business records by using a computer is acceptable, so you can prepare your financial statements by using accounting software. Also, keeping images of the original documents in CD-ROM or DVD-ROM are acceptable as an alternative to the keeping of the original documents themselves. However, the information of the conversion should remain complete and unaltered. Taxpayer does not need to apply to the Inland Revenue Department before conversion of business records in electronic records. That means you do not need pre-approval from Tax Department. Whether the source document is in electronic form when it is created, it is already an electronic record. For example, you can store the bank statement in PDF format downloaded from your internet bank account. So now, we will move on to the second part of today's webinar, Hong Kong tax systems. Hong Kong tax systems is simple and tax rates is low compared with most of Asian countries. There are 3 direct taxes in Hong Kong. First is profits tax, that is corporate income tax. Second is salary tax to individuals. Third is property tax chargeable on rental income from real estate. Hong Kong adopts territorial basis of taxation. That means only business profit, employment income, and property rental income arising in or derived from Hong Kong is taxable. Moreover, Hong Kong has no capital gains tax, no VAT and GST. Currently, Hong Kong has concluded more than 30 bilateral comprehensive tax treaties. Now let's talk about profits tax rate. The normal tax rate is 16.5% for limited companies and 15% for unincorporated business, such as partnership. From 1st April 2018, two-tier tax rate regime was introduced. Under this regime, eligible companies can reduce half of the tax rate for the first 2 million Hong Kong dollars assessable profit. That means 8.25% for limited companies and 7.5% for unincorporated business. Moreover, capital gains, dividend to shareholder, and profit outside Hong Kong are tax exempted. On the other hand, in order to protect tax revenue, provisional tax may be charged based on current year's assessable profit. Tax filing. Hong Kong companies can freely choose their accounting year-end date. For companies having year-end date between April to November, the tax filing deadline is 2nd of May of the following year. December year-end date companies have tax filing deadline on 15th August of the following year. Companies having accounting year-end date between January and March, the tax filing deadline is 15th November of the same year. The first profits tax return is issued around 18 months after the date of incorporation, and the filing due date is 3 months from the issue date of the return. In order to complete the tax filing, the company should submit the tax compensation report, audit the financial statements, and profit tax return. Offshore income claim. Unlike most countries, Hong Kong adopts a territorial source principle of taxation. Only business profits, employment income, and property rental income arising in or derived from Hong Kong are subject to Hong Kong profits tax. It applies to both residents and non-residents of Hong Kong. Although the concept of locality of the sources of income seems simple, in reality, its application often can be complex. No universal rule can apply to every scenario. Whether business is operated in Hong Kong and whether profits are derived from Hong Kong are determined by facts and depend on the nature of profits as well as of the transaction which give rise to such profits. Not all taxpayers' operations are relevant to determine the sources of profits. The key is focusing on the locality of profits generating activity, as distinct from incidental activities, such as accounting and auditing. All Hong Kong companies have legal obligation to do tax reporting to Hong Kong Inland Revenue Department (RRD), even the companies are eligible for applying offshore income claim. Please note that offshore income claim is not automatically given by RRD. Moreover, offshore income claim is a year-by-year basis exercise. In other words, successful offshore claim in 1 year does not automatically guarantee an offshore claim in other years because the companies may change in its mode of operation. taxpayers can submit a claim for offshore income together with its audited accounts and profits tax return to IRD. After receiving the application of offshore income claim, IRD will assess the case and usually raise queries regarding to the details of taxpayers' mode of operation and request taxpayers' transaction documents of some representative transactions in order to support the offshore income claim. Now, let's talk about the employer's return. Employer has reporting obligation for all its employees irrespective whether the employee renders service in or outside Hong Kong if their total annual income exceeds the reporting limit. The current reporting limit for single person is 132,000 Hong Kong dollars. On the other hand, income regardless of the amounts to married person, part-time staff, or directors should be reported. The reporting period is from 1st April to 31st March of the following year. Employers must complete the return and lodge with the IRD within 1 month from the issue date of the return, even though employees were hired during the year or the business has not commenced. IRD normally issues employers' return of the first working day of April. Employers' returns and all the forms IR56Bs must be signed by the same responsible person for a limited company incorporated in Hong Kong. They must be signed by employer's director, company secretary, or manager. Let's turn to the employee's tax filing. Employees should report income before deducting mandatory contributions to recognized retirement scheme (MPF) received or receivable during the year. Income includes from an office, full-time or part-time employment, or pension from a former employer. Even if full or partial tax exemption is claimed for offshore nature, the gross amount should be declared. Then employees should fill in the amounts to be excluded in the return and complete the appendix to the return. Same as employer's return, the reporting period is from 1st April to 31st March of the following year. Employees must complete the return and lodge with IRD within 1 month from the issue date of the return. IRD normally issues individual tax return on the first working day of May. Employee can claim for eligible deductions such as approved charitable donations and contributions to MPF, and eligible allowance such as married person allowance and child allowance in the return. That's the end of our presentation today. We hope that the information we have shared is helpful for you to understand about the basic accounting and taxation in Hong Kong. Now is the Q&A time, so let us review the pre-question from the customer first. Okay, the first question: other than the financial statements required by the company's audience, can we prepare accounts for our internal management purpose? Yes, the companies can prepare internal accounts, such as monthly or quarterly accounts for its management purpose. How should we choose our first accounting year-end date? You can freely choose for first accounting year-end date, which should be within 18 months after the incorporation date. If we receive invoice written in French, what should we do? In order to fulfill Hong Kong tax law, you should keep an English or Chinese translated version. Can we keep the documents in both paper form and electronic form? Yes, you can keep in both formats. On the other hand, both records in either form should be retained for a period of not less than 7 years. Can we prepare financial statements in US dollars? Yes, there's no restriction in currency used to prepare financial statements. refer to two-tier tax rate regime, what's the tax rates over Hong Kong dollars 2 million assessable profit. The tax rate is normal tax rate, that is 16.5% for limited companies and 15% for unincorporated business. Are the reporting periods between employers' return and profits tax return different? If the company's accounting year-end date is not 31st March, the reporting periods are different. The reporting period of employers' return from 1st April to 31st March of the following year. On the other hand, the reporting period of the profit tax return is accounting period. What's the tax rate of dividend income received by a Hong Kong company? Dividend income, whether from Hong Kong or overseas, is not taxable. Life questions. Are management accounts sufficient to the completion of the tax filing? No. Computed profits tax returns should be submitted together with the audited financial statements and tax computation report. Who is responsible for completing the salary tax return? Salary tax return is issued to the individual who has salaries, income, or other reportable income. Therefore, the employee, not the employer, is responsible for completing the salary tax return. That's the end of our presentation today. We hope that the information we have shared is useful for you to understand about the basic accounting and taxation in Hong Kong. Please feel free to contact us for any inquiries. Thank you for your time. We are Premia TNC and hope to see you again on next webinar. Bye-bye.